Welcome to PensionWise UK, your trusted channel for the latest pension news, retirement insights, and financial updates that affect millions of people across the UK. Our goal is simple: to keep you informed, prepared, and ahead of every major change coming from the government, HMRC, and the DWP. If you're new here, make sure to hit subscribe and ring the bell because updates like this could literally save you thousands of pounds in retirement. Let's be honest, retirement should be a time to relax, enjoy life, and finally reap the rewards of decades of hard work. But instead, more and more pensioners are finding themselves caught in a tax trap that is draining their savings far faster than expected. This isn't about small changes. This is about a hidden tax shock, quietly built into the system, that's catching people out when they least expect it. And the most worrying part? Many pensioners don't even realize they've overpaid tax until months later, if at all. So today, I'll explain exactly what's going on, how the 67% double taxation comes into play, and the steps you can take right now to avoid being one of the victims of this major HMRC rule change. First, let's understand the basics. Yes, your state pension is taxable. That still shocks many people, but it's the truth. When you retire, you no longer pay national insurance, but your income, whether from the state pension, workplace pension, private pension, rental property, or even part-time work, is all added up together. If that total is above the personal allowance, you pay income tax. Currently, the personal allowance is £12,570 per year, and here's the problem. That allowance has been frozen until 2028. This means that even though inflation is rising and wages and pensions are increasing, the allowance you're given doesn't move. That's what's known as fiscal drag, or in simple terms, stealth taxation. So, while your pension grows each year thanks to the triple lock, the rule that ensures pensions rise by whichever is highest of inflation, wage growth, or 2.5%, you're also being pushed closer and closer to the tax line. For many pensioners, this means they are now paying income tax for the very first time. Now here's where things start to go badly wrong. Imagine you receive the full new state pension, currently around £11,500 per year. That leaves you with just over £1,000 of tax-free allowance left. Add even a modest workplace pension on top, say £6,000 per year, and suddenly, you're well over the allowance. You might think you'd only be paying tax on about £4,930. But in reality, because of the way HMRC handles multiple income sources, your private pension provider might not know you're also receiving a state pension. They could apply a tax code that assumes your entire pension is taxable. So instead of paying tax only on the small amount above the threshold, you're taxed on the whole £6,000 and then taxed again on your state pension. That's how pensioners end up paying much more than they should, sometimes an effective rate of 67%. It doesn't stop there. If you take a lump sum withdrawal from your pension pot, HMRC may treat that as if you'll be withdrawing the same amount every month. So if you take £20,000 once, HMRC could assume you're going to take £20,000 12 times a year, £240,000 total, and tax you like a high earner. The result? Thousands of pounds in upfront tax deducted instantly. Let's make this concrete with a real-life scenario. John, a 67-year-old retiree, receives £11,500 in state pension and decides to take £6,000 from his private pension. On paper, his total income is £17,500, just £4,930 above the tax-free allowance. So his tax bill should be modest. But because HMRC applies the wrong code, John's private pension is taxed as if every single pound is taxable. He pays 20% on the full £6,000. Add in tax applied to his state pension, and suddenly his effective tax rate is closer to 67% of that extra income. This isn't just unfair, it's devastating for pensioners who rely on every pound to cover rising living costs. One of the biggest culprits here is the use of emergency tax codes. Whenever HMRC doesn't have up-to-date information about your income, your pension provider applies an emergency code. That often means your lump sum or one-off withdrawal is treated as if it's regular monthly income. For example, Mary takes £15,000 out of her pension pot to renovate her home. Under an emergency code, HMRC might assume she's taking that much every month, £180,000 per year. She's instantly taxed as a higher rate taxpayer, even though her real income is nowhere near that. Mary eventually gets the overpaid tax back, but only after filling out complicated refund forms like 55, P53Z, or P50Z. For many pensioners, that process is confusing and time-consuming. And sadly, some never claim the refund at all, meaning HMRC keeps money that was never owed. Now, let's go back to that term I mentioned earlier, fiscal drag. By freezing allowances like the personal allowance at £12,570 until 2028, the government is quietly increasing the tax burden year after year. As pensions rise, more and more people are pulled into paying tax, even if their real spending power hasn't changed. For pensioners, this means that even modest increases from the triple lock can push you into taxable territory. What feels like a win in one pocket is taken back by HMRC through the other. Now you might be wondering, am I at risk of this double taxation trap? The answer is yes, if you fall into any of these groups. Pensioners receiving both the full state pension and a small private or workplace pension. Retirees taking lump sums under pension freedoms. Those using the small pots rule withdrawing pensions worth under £10,000. Anyone with multiple income streams, like part-time work plus pensions. In each of these cases, misapplied tax codes, emergency taxation, and frozen allowances can combine to leave you paying far more than you should. So what can you do to avoid this tax nightmare? Here are some essential steps. Check your tax code regularly. Don't assume HMRC has it right. If you're receiving multiple pensions, make sure your allowance is spread correctly. Plan your withdrawals carefully. If you need money from your pension pot, consider splitting it across tax years. This prevents HMRC from applying emergency codes and keeps you in lower tax brackets. Claim refunds promptly. If you think you've overpaid, use the correct HMRC forms. P55 for partial withdrawals, P53Z if you've taken your whole pot but still have other income, and P50Z if you've taken the whole pot with no other income. Seek advice. A tax advisor or independent financial planner can help structure your withdrawals in the most tax-efficient way. Yes, it costs upfront, but it could save you thousands in the long run. Don't ignore letters from HMRC. If you get a P800 reconciliation notice, read it carefully. That's where HMRC tells you whether you've overpaid or underpaid tax. This isn't just about individual mistakes, it's part of a bigger trend. The UK tax system is becoming more complex, and pensioners are increasingly caught in the middle. With inflation, frozen allowances, and the triple lock driving pension growth, this issue is only going to get worse in the coming years. In fact, experts warn that by 2028, millions more pensioners will be paying income tax for the very first time. For those living on fixed incomes, the impact will be severe. So here's the key takeaway: don't sleepwalk into retirement assuming HMRC will get it right. A 67% effective tax hit is not just a glitch, it's a financial disaster waiting to happen. But it's also preventable if you stay informed, check your tax codes, and plan ahead. Remember, the system is designed to collect as much tax as possible. It's up to you to make sure you're not paying more than you owe. Thanks for watching Pension Wise UK. If this video helped you, please give it a like, it really helps spread awareness to other pensioners who might be at risk. And don't forget to subscribe and hit the notification bell so you never miss another critical update on pensions, benefits, and retirement changes. Stay informed, stay prepared, and I'll see you in the next video.